Welcome back to our video series on personal finance and investment. In our last video, we covered some fundamental investment basics such as risk versus return and learning how to identify what type of investor you are. In this video, we will explore various types of investment such as bank accounts, bonds, stocks, and mutual funds. Cash is often seen as the simplest form of investment. Money market accounts are one form of cash investment. These accounts are essentially the same thing as savings accounts, except that they give more interest and offer limited check writing abilities. You get more interest at the cost of having parameters on liquidability. When you deposit money in a bank account, the bank uses that money to fund their investments for business profits. In exchange for letting them use your money, the bank will pay you a small interest rate, around 1%. Savings accounts are almost risk-free because the FDIC insures most of them. FDIC-insured banks are insured by insurance companies, which are backed by the government. Up to $250,000 in savings can be insured in case the bank is unable to pay its depositors or goes bankrupt. There is a very low, almost non-existent probability that you will lose all your money from a bank account. Inflation does, however, threaten savings in bank accounts. If the inflation rate exceeds the interest rate for your savings account, then your savings account investment may be at risk of losing value over time. Overall, however, bank accounts are a very safe form of investment that entail very little risk. It is a low-risk, low-reward investment. While these low-yield liquid money accounts may not seem as appealing as more risky investments such as stocks, it is incredibly important that you have a safety net of liquid money, such as a savings account for rainy days. A bond is similar to storing money in a bank account, in that it generates money for investors through interest. They come in many varieties. Many companies, local governments, state governments, and federal governments will sell bonds to finance their various programs. When you hear people talking about the trillions of dollars that the United States owes in debt, they're referring to bonds and interest that our country still needs to pay off. Investors who buy bonds loan their money to these entities in exchange for interest. Different countries and companies have different interest rates because some bonds are riskier than others. The risk associated with investing in US government bonds is much lower than that of a Venezuelan government bond, so the interest rate will be lower on US Treasury notes and bonds. Almost every bond has a rating that reflects how risky it is. There is a link in the video description if you want to research more about different bonds and their ratings. One thing to keep in mind is that many bonds lack some liquidability. With the exception of bonds such as US Treasury bonds where you can directly cash it in at your bank, many other bonds such as corporate bonds must be sold in the secondary bond market for liquidation. Bond terminology can seem confusing, but it's actually pretty straightforward. Bond maturity refers to how long the government or company has before the bond debts have to be paid off. Bond maturity durations can range from a few days to 30 years. The face value, par value, or principal of a bond is the amount of money, not including interest, that should be paid off to the investor at the time of the bond's maturity date. The coupon rate is the bond's interest rate. If a bond has a 3% interest rate and the face value of a bond is $1,000, then the investor can expect to receive 3% annually until the bond matures. Some bonds have floating interest rates, which means that rather than having a predetermined interest rate, the interest rate floats around depending on different market factors. Stocks are probably the most widely known investment vehicles. They reflect the financial state of a company, and by purchasing them, you become a stockholder, which is a partial owner of a company. Stocks, like any other mass market goods, are controlled by the forces of supply and demand. Stocks that everyone wants to buy will have a greater demand, so their prices will increase to meet that demand. On the other hand, stocks that not as many people want to buy will have a lower demand and will thus decrease in value. The demand for a stock is affected by an infinite number of factors beyond an investor's control, such as political, economic, or environmental factors. If a company posts a quarterly report with better than expected profits, investor confidence in that company will be boosted, which will increase the demand and the price of that stock. A major terrorist attack might lower investor confidence, which could lower the prices of stocks. That was what happened on 9/11. The terrorist attack on the Twin Towers caused the Dow Jones Industrial Average to plunge over 14%, while the S&P 500 dropped over 11%. It is the infinite number of factors that contribute to the constantly fluctuating stock prices that make it extremely hard to predict stock behavior. In the description below is a link to Yahoo Finance, a free service that can help you find and track stock prices. A fundamental concept of investment is diversification. An investor can lower risk by diversifying their portfolio. Mutual funds use this principle to improve profits. Mutual fund companies such as Vanguard or Fidelity compile diverse portfolios with various stocks, bonds, and other securities for investors to purchase. There are a plethora of funds ranging from those that represent individual economies of countries around the world to those that represent entire economic sectors. Investors don't purchase the individual securities, but rather buy fractions of the overall portfolio. These companies like Fidelity and Vanguard continuously edit these portfolios, buying and selling assets as they deem necessary. Mutual funds allow many investors to use their combined financial resources to invest in a diversified portfolio for a reduced risk. Most big mutual funds are also professionally managed, with fund managers continuously redistributing the contents of the mutual fund to maximize returns. Diversification allows mutual funds to be generally less risky than stocks. However, keep in mind that this also means that investors can expect smaller returns on most mutual funds. So to recap, cash, bonds, stocks, and mutual funds are several different mediums of investment. Cash investments can be a low-risk, low-yield investment to generate interest on savings. Bonds are financial loans that pay off over time in the form of interest. They too are generally lower risk, lower reward investments, depending on what type of bond you buy. Stocks are partial ownerships in companies, where investors take fractions of the profits and losses. Mutual funds are collections of many different financial instruments that are used to create a diversified portfolio to lower risk. After determining which type of security you want to invest in, it is time to find the specific stock, mutual fund, or bond to buy. This is the hard part of investment, and many people spend their entire lives searching for mathematical algorithms or researching investor behaviors in an attempt to predict financial markets. As for now, thanks for watching, and I'll see you next time.